Hello, this is Richard Wilson and welcome to this short video on hedge fund investors. In this video I'm going to explain to you what types of investors hedge funds go after, why they focus on those types, how that totally changes as a hedge fund moves from $1 million to 30 million to 100 million to $1 billion plus, and why it's really important to understand this concept if you're working in the hedge fund industry, looking to raise capital, or running your own hedge fund. Surprisingly, few people in the industry go through formal hedge fund training, and that is why lots of people can work in the industry for years without knowing some of these basic facts about how it operates. Now, to start with, let's look at the bottom of the pyramid. If you're a hedge fund that has $100,000 to $10 million in capital under management within your hedge fund, there's a very limited number of investors you can go after. And before I even start to label any of these, please know that all of these types of investors are generalizations. The type of investors that you can go after in your country and your state for your type of hedge fund could be different. So these are general guidelines, what types of investors hedge funds typically go after. It's not set in stone, and don't take any action with hedge fund marketing or capital raising until you've spoken with somebody in your compliance department or an attorney that's an expert on these issues. But now, if you're a hedge fund that manages $100,000 to $10 million in capital, pretty much have limited options in front of you. You can go after friends and family, small wealth management firms, or some hedge fund seeders or fund of funds that seed small startup hedge fund managers or emerging managers, as they're called. Really, your options are limited here because people don't trust that you're going to be in business a year or two from now. They don't trust that you have a talented team, typically, that you don't have a long enough track record, that your business really isn't set up yet or profitable enough yet to survive long term. The second group here is $10 million to $100 million in assets, and these are often referred to as emerging managers still. And there's a small percentage of quote-unquote institutional investors that will look at emerging managers. A very small percentage of institutional consultants, a very small percentage of fund of funds, some family offices, and then your sweet spot in this range is really going after wealth management firms, very small family offices, high net worth individuals in a compliance approved way, again, seed capital providers. And really what you're looking for here is people who want to take the bet on the manager, which is not large yet. They don't have hundreds of millions of dollars in capital, but they can see your growth, they can see you reinvested in your business, they can see that you're going in a good direction. The next level up is when you get to $100 million or more. This is when you start to be referred to as institutional quality. Many times up to $100 million will be called an emerging manager, and many people, if you'll call them, they'll almost just hang up right in your face if you don't have $100 million in capital or more because you're not quote-unquote institutional enough for them. This can get very frustrating, to say the least, for anyone trying to raise capital, and many of you probably know exactly what I'm talking about. But when you get to this level, it opens a lot of doors for raising more capital. Do know that some institutional investors will still call you an emerging manager until you get to 250 million or even 500 million or more. But typically, 80% of the market is calling you an institutional manager after you get to 100 million. Now, when you get to this level, you can market yourself to family offices full on, to institutional consultants in most cases, to some pensions and foundations and endowments, but many will require you to have those higher asset levels. And the top of the pyramid here is when you get to $1 billion plus. I really have not heard of many allocations, if any, that require more than $1 billion in capital. Even insurance plans, pension funds, endowments, foundations, ultra high net worths, the biggest single family offices in the world, typically if you have $1 billion, that's a sustainable business plus some. And it's really about the institutional quality of your risk management procedures, the consistency of your investment process, the team you have in place. It's more about everything else going on in your business rather than asset level at that point. Once you get past 500 million, 800 million, $1 billion, the AUM issue, instead of being the number one roadblock in your hedge fund business, really is just a detail, and it's the other parts of your business that become center stage. So I hope this short summary of what types of investors exist in the hedge fund market, who you can go after at what stages, who hedge fund managers are raising capital from right now, today, at these different levels, is very helpful and educational for you. Thanks, and please join us again soon. It's Richard Wilson, and keep in touch.